Let's get a move on then and take stock of earnings. What is the outlook when it comes to Thermax's quarterly performance, given the rising steel and fuel prices did hurt margins? They did see the highest ever quarterly booking and has now increased their thrust on sustainability. Ashish Bhandari, the Managing Director and CEO of Thermax Group, joins in on the show to discuss that and more. Thank you so much, Mr. Bhandari, for joining in. Given the fact that margins did take quite a knock, largely on the back of steel prices, which were at an all-time high, walk us through how your margins are likely to shape up going forward, and what is the strategy in place in order to mitigate the margin pressure? How you're looking at the recent move as well with the excise duty cut? Does that impact the overall picture?
Hi, Aisha. A very, very good morning to you and to your viewers, and thank you for having me on the show. You're right. I think the margins were the biggest impact that we had, and metal prices in particular. If you will take a look at our earnings in our energy segment in particular, where the impact of commodity prices relating to steel is the highest, we have had a drop in margins, but it is not as much as the steel price impact would indicate. So, as a business, I think we handled that particular downturn resulting from increase in prices reasonably well. A bigger impact we had was actually in our chemicals business, where the Ukraine war affected not only freight prices, the input costs, availability of gas at our plant, but also some of our revenue comes from supplies to Russia, and that got impacted as well. So net, very, very challenging quarter. In terms of looking forward, one thing that we have done as a result of this is moved our prices up significantly, especially in our chemicals business, and that will, I think, moderate our growth to a little extent in that part of the business. We will see what the future holds. On the metal prices, as you heard from the person who was speaking before me as well, that there is some softening that has happened in the late April, early May timeframe. Remains to be seen whether this reduced pricing holds. If it does hold, I hope we can be in this Goldilocks zone where demand is reasonably strong and input costs are also manageable, which means we could look at a period where you have reasonable growth with reasonable profitability.
All right, fair enough. So long term, hopefully the picture should improve. Now your current order book, it's broad-based. You've seen the highest ever quarterly order booking of close to 3,396 crore rupees in the last 10 years. Which are the sectors that are contributing or constituting majority of your order backlog, and which are the industries that you see giving orders for the company in the future?
Okay. In the near future, the sector that was the strongest is also the sector which has been causing us a fair amount of trouble, which is the steel sector. And even as I look forward, there's quite a bit of demand from the steel sector, brownfield, greenfield projects, waste energy related projects, waste heat related projects from multiple customers. But that is just the this current 1 to 2 quarter phenomena. If I take a look at the last year as a whole, I would say multiple sectors in India have been on a rise, and not only steel and cement, refining and petrochemical, based on government projects, and then before that, food, pharma, chemicals, textiles. So it's genuinely been a very broad-based recovery. And even as we see right now, beyond the headline bigger orders, we have started to see continued strength across many sectors across India. So our channels business, which is working through 140 plus channels, had its third quarter of some of its highest numbers ever. Even the international numbers in out of Middle East, Africa, Southeast Asia have started to strengthen. So I think overall, quite pleased with the order scenario, and we hope to keep this momentum in the coming quarters as well.
Well, Ashish, yes, and your order inflow number especially looks very strong at 3,400 crores. If you can help us quantify, you talked about that you're looking at reasonable growth or momentum going forward as well. What could be that number? Are we expecting a 15 to 20% growth or a better number? And in terms of order inflow as well, how do the inquiries look? What is the pipeline? Where do you see the order inflows headed in FY23?
I think FY23, as I said, is um, unreasonable to predict this early with good 3.5 quarters still to go, with so much volatility in the given by the macroeconomic situation overall. I was just talking about from a strength in sectors that we are seeing in this in the next look forward looking 3 months, and my focus is not on the big orders. Actually, the big orders also come with longer lead times, more exposure to volatility in commodity prices. Our focus continues to be on the smaller kind of products and services based businesses, waste to energy, green related projects, projects emanating from government's ethanol policy, biomass policies. So continuing to build those. And there we see a reasonable pipeline. I can't commit to what our growth number would be, but I would definitely say it should be north of 10% as we look forward. What happens to the bigger projects? I think that will come and go based on factors that are not always in our control, and also they tend to be quite competitive with L1 pricing, etc. I am looking more for continued manageable growth that is profitable and coming from a wide array of sectors.
Growth of north of 10% is what you're expecting in FY23, and you're looking at more short-term orders. So that's the word coming in. But Ashish, I also wanted to get your sense regarding the capacity utilization, which is high at 90%. What's your outlook going forward? Are you looking at a big capex plan to bring down the capacity utilization?
I think across all our plants, we are now reaching a point where we are above 90% capacity utilization almost everywhere. That said, I think we can do a lot to debottleneck existing capacities, add shifts, work with our sub vendors. So for the immediate 12 months, we really don't see critical areas where we need capacity. We want to increase capacity long term, looking at the next 2 to 3 years, and in that regard, there are two particular areas of our business: our water and our chemicals business, where we are putting in new capacities, and those, as we go through this year, we will announce specific capex plans, etc. Overall, I think the rest of the business we can continue to manage our growth, but it is a time for a lot of small debottlenecking projects as opposed to any one or two big projects.
What is the outlook in terms of the kind of market share that you hope to capture, and what's the capital allocation strategy? I understand that the cash and investments stand at about 2,400 odd crores.
Look, I think we are a conservative company in that sense. Our overall working capital has been one of our strengths, and we look to continue the business in the same vein. We have increased our dividends this year, and that's been announced to 9 rupees, up from 7 rupees previously. And beyond that, we will continue to be conservative with our cash. From a capital allocation perspective, we will invest money in many of our renewable areas where we are doing build own operate plans relating to biomass, relating to solar and other renewable based projects. As I said, we will invest on our water business, our chemicals business, places where we think we can continue to build businesses over the next horizon. And on our R&D side, invest very heavily in new energy related technologies that are all relating to energy transition and helping India work through climate change.
Yeah, and I know that, since you took charge in the year 2020, you've been focusing and on really leveraging the company's ESG offering, with the biomass plants, solar OPEX, etc. I understand that this is a very important part of the business. So walk us through the plans going forward on sustainability playing a bigger role for Thermax.
I think sustainability has been one of the pillars for Thermax, not just for the last 2 years, from the ethos of the company, even before. Yeah, we've always, as a company, looked to do the right thing. And in that sense, even as we look internally within our company, our goal is to cut down our own energy intensity by 25% relative to 2020, even in the next couple of years, and then continue to reduce that number significantly over the next 5 years. So by 2030, taken some very aggressive plans in reducing our own intensity. As we look to the market at large, our aim is to be a partner to many of the industrial companies that are wanting to work through energy transition themselves. So working with them on energy efficiency improvement projects, helping bring more and more biomass, help them switch from coal into waste to energy, variety of different energy capture, waste energy capture solutions, converting them back into energy, bio-CNG. On the other side, our own products, taking our boilers to be electric, working on the water side on zero liquid discharge based solutions, and then starting to explore some of the modern new energy challenges relating to storage, relating to electrolyzers, which are all areas that we are working on. Very early to say whether we will be successful, but we definitely want to be ready for what the future may hold.
Okay, Ashish, we'll let you go on that note. Thank you so much for joining in and discussing your Q4 performance and the outlook going forward as well. For the markets, we are sitting at the highest point of the trading session.